Hi, I'm Dean Barber, founder and CEO of Barber Financial Group. Welcome to the monthly economic update. You need to understand what's going on with coronavirus. You need to understand how it's impacting the markets. There are strange things happening in the bond market today. The yield curves inverted all the way up to the 1 year, 2 years not quite there yet. I'm going to take some time. I'm going to have Jason Newcomer, one of our certified financial planners, joining me today. You're not going to want to miss this update. You're also going to want to share it with your friends. Enjoy. All right, Jason, let's do the thing here. So we think about what's going on with the coronavirus, and obviously it is on every single news channel. You can't turn on any news channel without having people talking about the coronavirus. People are freaking out. They're scared to death. The market seems like it's in a free fall. We want to put this in perspective for people. And so you created a chart that I think is worthy of going through. So walk us through this chart. What was on your mind when you put this together?
Yeah, so obviously when a headline is driving so many emotions in the news and driving markets, we don't know what's going to happen in the future. We don't know how bad coronavirus is, and I don't pretend to be an expert in microbiology or pathology, but what we can do is look at the past and what are some headlines or examples of typically negative news events that have happened and how have they driven markets in the past. So that's what I put together here. Was I looked going back to 2008 and kind of dug through old newspapers, old headlines, websites, and found a lot of things that if they happened, you would generally expect there to be some sort of a negative impact to the stock market, at least in the immediate.
All right, so let's go through some of these.
Sure.
We're starting out here. This is back January of 2008. So obviously what was going on here was the Great Recession, right? That was the routing of the market, all kinds of defaults, bank bailouts, automobile manufacturing bailouts. Mm-hmm. But you got the H1N1 swine flu outbreak on here.
Right, and that's not to draw a comparison between the coronavirus and the H1N1 swine flu outbreak. Those are two separately, totally different things. However, when that was going on back in the summer of 2009, everyone was just gripped by how bad is this swine flu outbreak going to be.
Correct, especially after we just got finished with the Great Recession, right? So that it did move the markets.
Yep.
All right, now you got the U.S. debt being downgraded.
Right.
You got you got the Ebola virus outbreak.
Yep.
Okay. Now that drop right there doesn't look as significant as today as what we're seeing today, but I think it's just on a different scale because I think the pullback there was somewhere in the 12.4% range on the Ebola virus. So it was a correction. Moved the markets lower. Again, there was fear, right?
Right.
People really didn't know, well, what is this? How are we going to be able to cure it? Is it going to become a pandemic? And of course, that's the exact same thing that we're hearing out of the coronavirus today.
Right. And it's not to make light of any of these, viral outbreaks. Like, obviously, the loss of life is tragic. But we're looking at things today just from more of an economic viewpoint, right? What was the impact that these viral outbreaks had on markets around the world? And historically, they have had maybe a quick downturn in the market, but really no long-lasting impact.
Right. All right, so let's move on here. You have, let's see, was there another? You got the U.S. Treasury yield inverting. Mm-hmm. Now that inverted to not quite to the 2-year, to the 10-year, right? So the inversion simply means that the 10-year yield goes below what the 2-year yield is. Well, now the 10-year was below what the 1-year was, right? But it never did quite hit below the 2-year. But it was pretty darn close, right?
Right.
I think that it's important for us to realize that there's always going to be something that's going on that's knocking the markets off their kilter, right? The markets are an emotional being, right? Because it's people trading and saying, oh, I got to do this, I got to do that.
Yep.
That's really not the right way we should look at this, is it?
No. I think, if you're working with an advisor, someone who's managing your investments, chances are good that you've gone through some sort of a risk tolerance exercise in the past. And you went through that exercise with your advisor. You selected a portfolio that was in line with your goals and your financial plan and your risk tolerance. if you're opening up your February statements and you are surprised or shocked compared to what the market did, looking at your portfolio returns, it's probably a good opportunity while we're still within earshot of all-time highs, right? We're only down today
7.5%, maybe 8%.
Close to 8% from all-time highs. Not a bad opportunity to revisit that risk tolerance discussion with your advisor and talk about should you be making any changes to your...
And of course, when we're doing the financial plans, one of the things that we're looking at is how much risk do you need to have in your portfolio in order to accomplish your goals? Or said another way, what's the least amount of risk that we could actually take and still have you be able to accomplish all your goals? So if emotions are running high and you're just thinking, gosh, I'm nervous, I don't want to see a big drop, get with the advisor and say, all right, what's the least amount of risk we can take and still accomplish our long-term objectives? And really, if you can look at your financial plan and you can say, you know what, I was at a 95% probability of success 2 weeks ago, and I'm still at a 95% probability of success, that means you don't have to worry. It means you don't have to think, oh my gosh, this is changing my life. Yes, the portfolio is down, but as you can see from the chart, normally it's a temporary thing. Well, It's always been a temporary thing. Sometimes the temporary period is a little bit longer.
Right.
All right, let's go to the yield curve. Go through this chart with us real quick, Jason.
Sure. So went back to 1978, and what we were looking at is the spread between the 2-year Treasury and the 10-year Treasury on top.
So the difference between the two lines, the two crazy purple lines here, that's the spread on the 10-year Treasury.
So the top chart there is the 10-year minus the 2-year, and there's a line that goes right across the middle.
This one's going to come across
the
middle.
That is 0. So anytime that purple line goes below that axis, that means that we've had a yield curve inversion. And what you've seen going back to the 70s is that typically when you have that yield curve inversion, a recession follows.
Right.
And it's pretty clear to look at that.
So we almost touched it.
Yeah, we did touch it, but just barely, and I think it only lasted a day or two.
Yeah, and it may have even just been an intraday thing.
Yeah.
Now, we did have the 10-year Treasury hit an all-time low. It actually hit 1.3%.
Yeah.
I think that was on Wednesday. And so that was, we've seen yields that low ever.
Right.
And at the same time, the 30-year Treasury hit an all-time low at about 1.7 something. So extremely low rates.
Yep. Yeah. Mortgage brokers are going to be busy with refinances.
Well, here's something that's interesting. We don't have a headline on this, but if you look for it, you can find it. With all the bad news that's out there, there was actually an article that came out on CNBC on Wednesday that said that housing starts hit a 12-year high in January. So that would normally be something that would tell us that the economy is on solid footing, people are buying and they're building.
Sure.
And it's a good sign, right?
Yeah.
But the coronavirus is really overshadowing a lot of what I consider to be some other good things that are happening in the economy.
Sure, yeah. And the economy and the stock market are two separate things that are kind of tethered together generally, but there's a good analogy that I've heard where you'd imagine a man walking his dog through a park, and they're connected with a leash, and the dog might get distracted by a squirrel and run to the right, and then get distracted by another dog and run back to the left. The man, though, he continues walking in a straight line at a steady pace, and they'll wind up at the same place at the end. But this dog is kind of a representation for the stock market, right? It's erratic. It's moving all over the place for no apparent reason. But
the man's the economy.
The man is the economy. Yeah,
I get it. That's a really good analogy.
Yeah.
I can see it. I just hope the dog's not too big, so pulling the economy all over the place. Sometimes you do see that happen, though. And I think that's what we're seeing here with that 10 and that 30-year Treasury hitting those all-time lows is maybe some false signals or some uncertainty about what's going to happen with the economy because of the coronavirus is really pulling down those financial instruments in the 10-year and the 30-year Treasury.
Sure. Yeah.
Right. So you did another chart here, Jason, and that was looking at what happens to the markets after a yield curve inversion.
Correct.
So take me through this slowly.
Sure. So there's a lot of different numbers on here. I think the big takeaway is generally when there is a yield curve inversion, it signals that there's rough times ahead, whether it's the stock market or the economy, that you're going to have some turbulence. It is not a good timing mechanism, however. So what we're looking at here is, again, going back to the 70s, every time the yield curve between the 10-year and the 2-year inverted, and then where was the S&P 500 the day of the inversion? What about 6 months after, 12 months on, 24 months on, 3 years, and then 5 years
This one in
on?
78 really didn't do much, right?
Yeah, no.
I think but that was a deal where the economy had just come out of that really slow period there with the energy crisis in the early 70s. But here's one I think is really interesting, right? So you get the yield curve inversion on 5/26 of 1998, because 98, that was just prior to the dot-com bubble.
Right.
Okay. Well, 6 months later, you're 8.5. 12 months later, you're 19.3, and then you're 26%. 24 months later, but if you come on out here 60 months later, now you're a minus 14.
Right.
So that yield curve inversion doesn't mean it's an immediate recession. But it does signal, and has in the past, that that's something that could be coming down the road. There's just nobody putting it on the calendar saying this is when it's going to start.
Right. This is not something that you'd want to look at and say, based on when the yield curve inverted, I need to move my stocks into bonds or make an overhaul to my portfolio, because it's not a good timing indicator.
Right. It could mean that maybe over the period of the next 6 to 8 or 12 months, you want to be able to maybe you get a little less aggressive, or maybe you reduce the equity exposure a little bit.
Yeah, if nothing else, it's just another good opportunity and a reminder to look at your portfolio, the level of risk that you're taking, and what your exposure is should things get bad.
And that really should be looking at that on a regular basis.
Yeah, absolutely.
All right. So let's go to the coronavirus here. And I'm going to put a link to this particular website, because I want everybody to really understand what's going on here. There's two numbers that we see here that are plastered all over the news, and you got to dig deep in written articles to actually find the third number that we're going to discuss here. The first number is the 82,550. That's the total number of confirmed cases as of the day that we're recording this. And of course, we know by the time everybody's watching this, there's going to be more.
Right.
Now, 2,810 deaths. So those are the things that you're seeing. What you don't see is the 33,252 recoveries, right? So those people are no longer infected. So I think a better way for us to look at this from a logical standpoint, not from a sensationalism or, let's scare the heck out of everybody. What are the number of active cases, right? How many people today are contagious? The people that could actually pass the disease to, or the virus to, another person. And what you see here on this chart down below, and again, we'll put the link out there so that you can go look at this yourself. But what we're seeing is that the total number of confirmed cases, the path of growth has slowed dramatically. I mean, if we were still continuing up like this, I mean, we'd see this chart way, way, way up here. So this has slowed its rate of increase, but the number of cases here where people have recovered has increased substantially. So really what we saw from about February 17th through the date of this recording, we saw almost a 20% decline in the active cases. And so I wish that we could get some headlines out there that we're talking about, that we're actually seeing a decline in the active cases, because we are having, a great big number of these people that are recovering. So have you read that anywhere? Have you seen?
No, it's all about the total confirmed cases and how many people have died from the virus.
Right. And so then you get this hysteria of, well, I'm not going to travel. I'm not going to go to the grocery store. I'm not going to the gym. We're canceling our vacations. And I get it. We've got to contain this thing because we don't know really what's going to happen. So I think that looking at these charts, though, and looking at reality, that the containment has been good. Right, you can go through this chart and you can click on any one of these, mainland China, and you can see, here's my confirmed cases, here's my deaths. Well, that's where most of the deaths have occurred, 2,744 of them. But look, 32,879 people in mainland China have recovered. Now, what I think would be even more fascinating to understand is, of the people who have passed away, did they have some sort of other problem, other respiratory problems? Were they older? Maybe they, had some sort of a heart condition or something like that. I don't know that there's that much data out there on that right now. But and the other thing that I haven't seen is, what's the actual time from when you get coronavirus to when you recover? I haven't seen any data on that. I've got to imagine, though, with over 33,000 people having gotten the virus and recovered, there's got to be something coming out on that on the averages. And so when I look at this, yes, I'm still nervous about it. Yes, it still is worrisome. But I think that we're seeing things trend in the right direction with the number of active cases dropping so dramatically here over the course of the last 10 days.
Sure.
Any other thoughts you want to share?
Just as always, be aware of what's going on in the news, whether it's the coronavirus or an election coming up. Be aware of what's going on, but don't let your emotions override the decisions that you need to make from a sound financial standpoint.
All right, good stuff. Jason, thanks for being with me today.
All right, thanks, Dean.
For all you YouTube viewers out there, please like this and subscribe and hit the little bell icon, and that way every time we put out one of these videos, you'll get a notification.